April 2014, pool it or lose it. Can I just ask a quick show of hands in terms of people that are already aware of capital allowances? Everybody. This is going to be so straightforward and so easy. That's great. Have we got some accountants as well as lawyers? Accountants aren't sticking their hands up on purpose, I think. Okay. Let me take you through the agenda. The objectives of this session is to deliver an awareness of capital allowances. I'm not here to talk about how you become capital allowance experts and tax experts on capital allowances, but there's a fundamental change that is happening in April 2014. And everybody in this room needs to be aware of it. Okay. So the logic today is to talk you through a little bit on capital allowances, understanding the rule changes and the implications for lawyers and accountants, but particularly lawyers. Okay. The rule changes had no impact whatsoever in 2012, really, for lawyers. 2014 is a totally different scenario. Okay. And we'll look at the 3 or 4 steps that you need to ensure every time there's a commercial property transaction you need to have complied with. Okay. So we have a video, which hence all this, I have 2 wires and there's speakers and there's also, it probably won't work in terms of the volume. So if we ask you just to be sort of slightly quiet during the video, because otherwise it'll come out of the laptop, but let's see what happens. As I said, we'll then explain what capital allowances are. You're all aware of them, but just in case people aren't quite as aware as others, we'll do a couple of slides on that. We'll also then talk about how a client goes about claiming those allowances and what they mean to the client. Okay. A quick example. The example we'll use is actually a law firm's purchase. So we thought it was quite apt for this particular presentation. The legislation, as it currently stands, so any transactions that you actually will carry out that conclude prior to April 2014, what's going to happen to those and what's going to happen on the 1st of April or 6th of April, depending on the entity. Okay. The process that's involved in doing that, which the process is 1 slide. Nobody likes lots of process slides, so we've kept it on 1. And the next steps, in other words, the things that you guys need to do. Okay. So the one thing I'd like to point out before we show the video, there's 2 logos in the top left-hand corner. So we're massively proud to be the only capital allowance firm that's endorsed by the Law Society. So they've been out to the marketplace and they've selected Catax as their partner for a 3-year relationship. Okay. So any lawyer that goes back to the Law Society and asks a question, uses the BAS unit in terms of getting advice, they'll be pointed back to ourselves. Okay. And we'll talk about a registration portal that allows you to go and access documents free of charge and templates that will help you carry out those transactions post-April 2014. Okay. The other one is for the accountant in the room, is the fact we are the only affinity partner for the Institute of Chartered Accountants England and Wales. So the 2 main bodies in property transactions and capital allowances have said that Catax are the people to deal with. That's my only selling piece in the whole presentation.
Capital allowances are a valuable form of tax relief for commercial property owners under UK law. Research by Deloitte suggests that 9 out of 10 owners of UK commercial property will be due a sizable tax benefit because of unused capital allowances. And we're not talking small change either. Our average claim is over £125,000. The reason so many people are owed money is that identifying capital allowances isn't easy. In fact, it's so specialist that some of the UK's biggest accountants have partnered with us to carry out the work for them. Our expertise lies in uncovering unused capital allowances on things like air conditioning and cabling, or heating, lighting and security systems. In fact, everything that would stay in a building if you tipped it upside down and shook it. So far, we've identified more than £500 million of unused capital allowances for our clients. So, if you're a UK taxpayer and own a commercial property, call us today. We only charge a fee if we can claim more than £50,000 of capital allowances, and we won't ask for it until your tax benefit is approved by HMRC.
So, what are capital allowances? Capital allowances are a form of tax relief on items that sit inside a commercial property. They're only of benefit to people that pay tax. So we talk about pension funds, not applicable as a general rule. But they are the types of things that they're classified as plant and machinery, and they're embedded into the building, into the infrastructure of the building typically. So the likes of, in this room, air conditioning, the cabling, so you can see the air conditioning, you can see the heating system. What you can't see is the cabling that's under the floor, the pipework that's around. Those items are all applicable for capital allowance relief. Okay. And typically, when a building is bought, okay, the building is bought for £1 million, that building is then not looked at for capital allowance work as a general rule in about 9 out of 10 cases, as we'll see shortly. But what we do, if we do identify those allowances, those capital allowances will have the effect of reducing the profitability for the client, therefore reducing their tax liability. So capital allowances give tax savings for clients. That's the important point to take. And when you see the worked example in a moment, you'll see exactly what we're talking about. It does say on there capital gains and sideways loss relief. I'm not going to go into the intricate details of capital allowances and how they can be used. Suffice to say, if we identify capital allowances, and if we identify £100,000 worth of capital allowances, and you're a 40% taxpayer, it's worth £40,000 of tax rebate and tax reduction going forward. Okay. That's why it's really important. When you see some figures and you see the rule changes, you'll understand why. On a typical property of £1 million, you'd expect to find 15, 20, 25% of that purchase cost is applicable for capital allowances. So we've put on a nice little picture there to demonstrate that. Land and buildings is where the property sits, and so the accountants in the room will understand that. However, what should also happen at the time of purchase, from 2014, the allowances need to be identified. Okay. And if you think about a £1 million building, that's £250,000 worth of allowances. 40% taxpayer, that's £100,000 worth of tax benefit that if they don't do this work, they will lose. Okay. So, the reality is that circa 90% of commercial properties have not had this work done. And in actual fact, in terms of the people in the room, we have done work, completed work on about 17 of your clients, of the people sat in this room. You might be aware of it, you might not be aware of it. Okay. You will have had some involvement in terms of the accountants and the lawyers particularly. So in terms of lawyers, we'll have asked you for copies of purchase contracts on your clients. We'll be looking at CPSEs, and I'll talk about those shortly. But 17 clients already from the people in this room we've carried out this transaction for. Okay. So the legislation came out about circa 1940-ish. The logic, the principle behind capital allowances, and this probably explains why the rule change is going to happen. The principle behind capital allowances is that when economic times are harsh, then the government needs, or HMRC, or the government needs a way of helping people boost the economy. So after the Second World War, if you buy a property and you paid £1,000 for a property, you get 100% relief on that property. Okay. Between 1940 and 2014, that has changed, obviously, in terms of the percentage that you get back. So currently this year, if you buy a property this year and you pay £1 million for that property, you would get the first £250,000 of those allowances back in the first year. If you bought it 14 months ago, you'd have got the first £25,000. If you bought it 23 months ago, you'd have got the first £100,000. 3.5 years ago, the first 50,000. The rules change every year. So when we think there's a challenging economic climate, what the government will do is increase that allowance to stimulate, effectively stimulate the commercial property market. Okay. So why do they do it? If you buy a commercial property, they believe for every £1 of relief they give, they'll get approximately £6 back. We don't quite know how HMRC have come up with these figures, but the logic is that I buy a building, I'll allow someone to rent that building from me, I'll make some profit, I'll pay some tax. The people that rent the property, they'll pay some company tax because they'll make some profit. They'll employ some people, they'll pay some income tax, and then we'll all pay some VAT. and then we'll all start again. So I'm not here to teach economics, but that's the basic principle behind capital allowances. It's available in about 130 countries around the world. It's fairly self-policing because it's global. It's not something that's going to disappear. Because of course, if one country decides not to allow capital allowance relief, then the big property funds just take their money and they go and invest in another country. So they can't stop capital allowances. That's the principle behind it. Okay. We can go into the legislation, but I'm guessing that most people in the room will not want to go through the legislation line by line. But that's the specific legislation we're talking about, 562. And that basically means that items, it lists the amount of items that are available for capital allowance relief, and it lists the rate at which you can receive relief on them. Okay. The legislation changes, as I said, it goes from different rules from in terms of how much you can relieve back up front, how quickly you can get your relief back. The big rule change, April 2014, is if I bought a property today, I will have basically an infinite amount of time to claim my relief on that building. There's no legislation that stops me. April 14, if I buy it first week in April 14, I have to complete this work at the time of purchase. If I miss it and the transaction goes through, the allowances are lost. Okay. So the implication is that that £40,000 worth of tax relief for that £100,000 of allowances is gone forever. Okay. So we can't, on the CPSE, when a client comes to us and says, I'm not really sure about Section 19, I'll just put NA. You can't put NA anymore. You know, if you allow a CPSE to go out to a purchaser with NA, there are serious consequences. Okay. So, let's first just make sure we're talking about the right clients so we understand who the clients are that you're acting for and who it relates to. This does not apply to residential properties. So let me be perfectly clear on that. No residential properties. Okay. So commercial properties, anything where a trade is carried out, offices, warehouse, things that get ignored and forgotten here, GPs, dentists, vets, hotels, care homes, anything where a trade is carried out effectively, that building is classified as a commercial building. The property owner needs to be a UK taxpayer. So obviously we're getting tax relief. You need to be paying tax in order to get tax relief or to be able to use those losses carried forward. So it doesn't apply to pension funds. We do a little bit of work with REITs, but not, again, because of their taxable status. But again, don't ignore individuals, sole traders, partnerships, companies, LLPs, trusts, offshore trusts. Again, people assume, well, he's bought it in an offshore trust, it's not applicable. They will still pay 20% UK non-residency tax. They still pay it. Okay. So the basic principle is if you're acting for a client who owns a commercial property or is buying a commercial property and they pay UK tax, they need to do this. Okay. So this is the example. We won't say who the law firm is. Some might know, some might not, but it's irrelevant. They're a testimonial case for us, so we're not saying anything that we shouldn't be saying. They purchased a building for £8 million. We found a fraction over £2 million worth of allowances. For the assumption of this, I'm not going to say that they're 45% taxpayers, but they're 40% taxpayers. £800,000 of tax relief because they completed this. They were not going to do the capital allowance work. It had not been highlighted to them. The law firm that acted for them, which I won't say the name, is one of the most prominent Northwest law firms. They didn't do the capital allowances on it. Now luckily, because we got involved just in time, we were able to apply the capital allowance work, complete the report and give them this opportunity. Now, if that had happened post-April 2014, they'd have lost it, gone. The £800,000 worth of tax relief would have, and not gone for the people that have bought the property, gone for the people that have sold the property, because both parties can gain, and gone for any future purchaser. £800,000. Okay. So, if law firms do nothing, post-April 2014, here effectively are the consequences. So if your client is the purchaser of the building, okay, and the CPSE is silent on capital allowances, or is vague on capital allowances, and there's nothing in the purchase contract, then effectively your purchaser, your client, is forgoing all ability to claim any of those capital allowances. And in that scenario, it was an £800,000 benefit. It's gone. You can't come back in a month's time and say we've had a rethink. It's gone. It's got to be done at the point of transaction. Okay, and that's a significant rule change. That property I just talked about, because they bought it last year, summer of last year, they can go and make this claim next year, the year after, the year after. It doesn't matter when they start the claim process. Clearly, you'd want to start it as soon as possible because you're starting to get tax relief straight away. Okay. But if they bought it mid-April this year and they didn't do the work, it's gone forever. Okay. So if you're acting for a vendor, so if you're acting for the seller, again, the failure to establish the capital allowances pool, which is not your job, it's what we do, it's what we're brought in to do. The failure to establish that will mean that they will forfeit those allowances. They're gone for them, they're also gone for the purchaser as well. Okay. So there's two parties that will be massively aggrieved once they find out that actually they didn't have any advice on capital allowances. And I think the challenge is, you know, the fact that you've come to this presentation shows that you understand either you're dealing with capital allowances now and you've got a plan of action that you use, or that you need a plan of action, you recognise there's potential consequences of not doing that. So you know, you're already halfway there. The challenge is that 9 out of 10 buildings have just not had this done. Last year, according to HMRC figures, just over 98,000 non-residential properties were purchased over £40,000. I found that figure astounding, but that's the HMRC figures. We believe that circa, in terms of our remit, we work typically on properties at sort of £400,000–500,000 upwards as a purchase price. We believe about 10% of that 98,000 will fit into that category. That's 10,000 properties last year. The figure was 98,000 actually for the last 3 years. Prior to that was 92,000 4 years ago. So if we assume the same figure this year, that means there's 10,000 commercial properties that are going to be transacted between April 2014 and March 2015. We're the largest in the UK in terms of the volume that we do. We think we do as many as the rest of the marketplace put together. And we did circa 1,400, almost 1,500 properties last year. Of those 1,500, less than 6% of those were purchased during that year. So you think about the impact. What we're actually saying there is that about 70 buildings that we looked at were buildings that were purchased in the year out of those 10,000. So 10,000 transactions will take place next year, and every one of those needs to have somebody look at the capital allowance situation and ensure that their client is being safeguarded. Either protect the allowances so they can maintain them and keep them, or use them as a tool, if he's acting for the seller, to negotiate with the purchaser. Okay. If you're acting for a purchaser, absolutely the same thing applies again. Okay. So the papers on it are sort of circa 80 pages of legislation. We've got it into 3 bullet points, which I think is pretty astounding. But these 3 bullet points are really the things that involve you guys. So the first thing is, at the point of sale, the allowances need to be identified. Now, that's typically an 8 to 12 week process to identify those allowances. You're the people that act on commercial transactions. You know how long it takes to do a commercial transaction. Some of those can be weeks, yet you've got an 8 to 12 week process that needs to take place in order to identify allowances. So the first thing is, as soon as there's a sniff of a client that comes to you, you need to be on the case with this part of it, because this could delay the sale and it potentially cost the sale, I suppose. So at point of sale, those allowances need to be identified and pooled. I'll explain what we do to do that on the next slide. The CPSEs need to be completed fully. Section 19, I think it's 13, 14 questions. It needs to be completed accurately. And I'm sure you've been in scenarios where your client's completing that for you, acting as the seller, and they get to certain parts and they're not entirely sure, well, they're not entirely sure what capital allowances means, let alone whether they've claimed them or not claimed them. And so, in the interest of time, they might put NA, unknown. You can't do that anymore. I'm not saying we should have done it in the past, but you really can't do that now because the consequences are immense. Okay. Once the allowances have been identified, if it's £100,000 worth of allowances, then the S1 and 80 election typically will have to then be set in place with that figure mentioned, with the apportionment to each party. And it might be that actually the seller is retaining all those allowances. It might be that they're giving them to the purchaser. It might be they might be splitting them, whichever percentage split they want to do. Okay. Well, the point is you have to put that election in place. So you can't not have an election anymore. So we see purchase contracts, around about 20%, 23% of purchase contracts we see have an election in. The rest don't. So the new rules state you must pool the allowances first, so i.e. bring someone in. Whether you use other people or use ourselves, just bring someone in. Do not just not do it. We pool the allowances, we find the amount. That amount is then apportioned between the buyer and seller, and the election is created and put into the contract. Okay. And then both parties have to notify HMRC within, they say, a reasonable time frame, because HMRC like phrases like that, which really means we have no idea what they mean and they won't tell us. So the only thing we can conclude from that is that tax years remain open for 2 years, 21 months in terms of individuals, but effectively 2 years. So at the moment we are making the assumption that you'll be able to, as long as you notify HMRC within a 2-year period, then you'll be okay. We suspect that should the volume of claims and rebates rise, that they'll shorten that timescale. That's why we think they've put reasonable timescale. Okay. If those 3 things do not happen, the allowances are lost forever on that building. Okay. And in the scenario there of the law firm, that's an £800,000 loss. You know, I'm not a lawyer, and I don't purport to be in any way, shape or form, but I think the consequences of that not being done, you guys can work out what the implications might be further down the line. And I don't think it'll be an issue in April or May or June or July, or I think about September the first case will come where a client comes back asking for the money, and I don't know how that will go. Okay. But that's when we think it'll start, and what we expect is, whilst we're geared up now and we are through the Law Society, we've got information going out on a weekly and monthly basis from themselves to you guys, to the members. We suspect that we'll get an influx of already the amount of lawyers that are registering on our portal just for the information is far outweighing accountants. Apologies to accountants in the room. Because of course it now goes off the accountant's toes, not quite off the accountant's toes, but it becomes more into the lawyer's remit. Because typically the accountant might not be involved at that point of purchase, but the lawyer always will be involved at that point of purchase. Okay. We suspect it massively will increase towards the end of the year as it starts becoming common knowledge in terms of the issues that have arisen. So, owners that bought a building pre-2014, which is the vast majority, bear in mind we're only talking of sort of 10,000 properties that will qualify next year in terms of purchase price. All the rest of the other 800,000 plus properties in the UK, it's business as usual. Okay. So there isn't an issue. The one point I would make on that is, as it becomes more common knowledge, of course, we do circa 150 clients a month in terms of reporting instructions. We're just over 4,000 cases now that we've acted for. We think, as it becomes more common knowledge in the marketplace, what you'll find is previous clients or clients that bought buildings 3, 4, 5 years ago will come knocking on the door and say, what do I need to do about this? So one of the things that we have in place is that we'll actually go and do an audit of your client bank in terms of with the clients that have already bought commercial buildings over previous years, Because if they've not done it, they can do it now and start getting tax relief. You know, theoretically, they could wait for years and years and years before they did it. But you know, why leave that money with the taxman? Why not take it now? So if you bought a building pre-April 14, no impact. If you buy post-14, you must do these three things. Okay. Pool the allowances, create the election of the agreed split, and both parties notify HMRC. And that advice has to begin from you guys to your clients. As I say, I'm not going to go through the process. There's 8 steps to the process we have to go through. It takes 8 to 12 weeks. We've just completed that process in 6 days for a client who's an existing client who understands it inside out. The lawyers and the accountants are totally on board, PKF or BDO with the accountants. So they knew exactly what needed to happen. Of course, the client came to us on Wednesday after New Year, the Wednesday after that, to say that he's got a tax bill on the 31st of January, what can we do? You know, the tax bill was known about, must have been known about 3, 4, 5 months before, but as is the case, January is our busiest month, and people always tend to come to us the first week in January when they start to realise they've got a tax bill coming for individuals. But we can't guarantee that we can do that in 7 it's not going to happen. The average is between 8 and 12 weeks. Okay. One quick slide on us, we have over 4,000 clients. In fact, before I do that, to reiterate, the only endorsed partner by the Law Society and the only affinity partner with the Institute of Chartered Accountants, England and Wales. Just 4,200 clients at last count. Business partner to the British Hospitality Association. Hotels and restaurants, almost without fail, are all inside that. We do a lot of work with those people. We're an ISO 9001 accredited organisation. We're going for about just under 6 years. And we're serious about our business. We're about 45, 46 staff. And offices in Manchester, London and Birmingham. Okay. Our Manchester office is not Manchester because you're in Manchester, you know what Manchester is. We're in Altrincham. Okay, but the rest of the world doesn't understand that, so we say Manchester. Yeah. So for me, in terms of next steps, clearly we want to work with you, otherwise we wouldn't be sat in this room. But I think more importantly is the portal there, which the details are on. By registering on that, which it doesn't cost anything, we set it up with the Law Society so that we could give information. So on there we have structures of 1980 elections and the way the wording can be utilised. We have different documents and different bits of advice and information sheets that will help you in terms of speaking to your clients. So it's a really, really useful portal, and it just means you're kept up to date with the latest information. Okay, so I'd recommend that. I'm probably a few minutes over, so I apologise, but that's it. So, any questions, or are we all good to go for April?
In terms of the properties that are already owned, and your process, if there was no clear indication of exactly what the capital allowances were some years ago, is that part of your process to determine that?
Yep, it's a great question. In terms of the process, which I didn't want to go and do a 10-15 minute piece on, part of that process is the due diligence to go back to 1998 to establish prior capital allowance claims. You can only claim on an asset once inside a building. So we have to identify and have evidence, documented evidence, that no prior claims have been made. If we find evidence that prior claims have been made, we clearly, we then we can't do a report for the client. Sorry, someone else has already done that, and that's a tick in the box, and there's no issue there. We don't charge for that work. So once we identify that allowances have not been claimed, that then gives the opportunity for us to go to the next stage, which is a forensic survey. We are liaising with yourselves and with the accountant at this stage. So we've checked the tax computations for the previous 6 years. We've checked in terms of purchase contracts of prior owners. If everything's okay, we do a forensic survey. The survey comes back to the office. A tax technician produces a report, and that report goes to the accountant with the £100,000 of allowances on, or whatever the figure may be, and they then submit the tax computation amendments for the client, and they get the rebate. They don't get the full £40,000 in that scenario in year one. Okay, they get approximately 30% of that, and I won't go into the, but approximately 30%, and the rest is then at sort of 20% and 10% going forward. Okay.
Is it presumably therefore best practice in future that when you have a sale and purchase of a commercial property, that the sale and purchase agreement itself should deal with these issues as to how the capital allowances are going to be divided between vendor and purchaser? And a corollary to that is, if that hasn't been done, how does one negotiate between vendor and purchaser after exchange of contracts to deal with that issue?
Typically, prior to April 2014, if we're acting for a purchaser, the purchaser will ask us for advice on how they can not raise the questions of capital allowances. And the reason for that is the purchaser does not want to alert the seller that there are potentially capital allowances available. Okay? So that's what happens for properties bought prior to April 2014. We also get the scenario where a purchaser will come to us and say, it mentions there's an election in there for £1, which you've all, I'm sure, seen, to say that allowances available to the purchaser are only £1, the seller is retaining them. So they'll come to us and say, actually, we need some help with this. The seller is a pension fund. So we'll go back and say, here's the wording that you should go back to the seller's lawyer to say, actually, are you sure you really mean you want an election for £1? Or in reality, is that just something that you've always done? Because there is no benefit to that seller in that particular scenario. It might be that the seller has no tax liabilities. So again, there's no benefit there. So on pre-April sales, which the vast majority of your clients, in fact, all of your clients that you have will be pre-April sales, because we've not got to April, that scenario applies. So if we do an audit on any of your clients, that's what we'll find typically. In terms of what should you do, it absolutely has to, from April onwards, it's not a case of can we discuss afterwards. Once the transaction is completed, if it's not happened and gone into the purchase contract, and the election has gone into the purchase contract, they're lost, they're gone. Obviously, exchange of contracts should be having the conversation, the dialogue will take place. That's the time to make sure it's raised if it's not. But the problem is exchange of contracts might follow with and will complete in 28 days. We're now right up against it in terms of the length of time that it's going to take us to do the process. So you must mention it in the purchase contract, and I would suggest the earliest possible opportunity. There's no opportunity now for a purchaser to think, great, if I say nothing, keep quiet, I've got an opportunity for taking these allowances. Those days are gone now. Now it is going to become out to the forefront, and it's potentially a negotiation. And if you think about it, if a limited company is buying from an LLP that's a 40% taxpayer, a limited company 20% taxpayer, there's clearly a different value to those allowances to each individual party. So it's not quite as straightforward.
To what extent do you need to be considering the impact on the purchase price itself in terms of the allocation of a portion between the allowances? I mean, if you're saying that potentially a buyer can take the benefit of hundreds of thousands of pounds worth of allowances, how is that advantage then split between the parties? And if it needs to be split, which presumably a seller would want to, surely that needs to happen a whole lot earlier, at the point when the commercial agent agrees the sale.
Yeah, absolutely. You are totally right. The problem is, of course, that most, I think we have got some commercial property agents in here as well, so I'll be a little bit careful. Most commercial property agents don't really talk about capital allowances as a general rule. We have some fantastic examples in terms of companies like WHR, where we've done some phenomenal work with some of their clients, many tens and tens of millions of pounds in terms of some of the properties they've acted for. I'm not saying they're good, bad or indifferent, as an example. But the main point on this is the earliest possible time that those allowances can be talked about should always be the driver. The later we leave it, the more chance there is in terms of we've already agreed a price, now identify allowances. You've then got the bar string issue then. And as you say, there's several £100,000. In that case, there was £2 million, an £8 million purchase. You know, Manchester City Centre, that's now out of kilter. That's, 4, 5, 10, 15, 20 million pounds. They're not out of kilter. And in London, that is the norm. There's nothing under £5 million in London in terms of the properties we act for. So they do need to do it at the early stage. But you are right, it's going to cause a problem. Because, of course, there is now something else to negotiate about. Well, that's where, obviously, if the seller is desperate to sell, clearly the buyer's in a much stronger position and vice versa. It doesn't impact on the price of the property going forward in terms of capital gains, which I don't think was the question, but just in case that's people's thought process. There is no negative impact whatsoever for somebody claiming capital allowances on that building. Okay. Does that answer it?
Yes, it does.
Yeah. Okay.
Bearing in mind the situation with regard to capital allowances, is it appropriate therefore for advisors to talk to their clients about assessing their capital allowances available on their properties now, particularly bearing in mind the length of time it might take if they had to rush this kind of situation at a sale?
Every one of you is sat here with a client bank of people that own commercial buildings, and every one of those is due tax relief. For me, as an MD of Catax Solutions, I want to service every one of those clients, clearly. Okay. The challenge is that, not you people here, because you've actually come up at 8:30 or 8 o'clock on a Friday morning, but the general apathy of the profession means that people would rather not have that conversation. I think it's a great opportunity to have a conversation with a client that you might not have spoken to for 2, 3, 4, 5 years, where you've acted on a commercial property. An accountant gets to speak to their client every year because they have to, whereas lawyers don't always get that opportunity. So for me, the auditing process that we provide for lawyers, I think, is a must. So if you sat there with 100 clients or 1,000 clients or 10 clients, whatever it may be that own commercial property, let's sit through that list, let's go through them, let's produce what we call a benefit analysis, which tells them what it's likely to be worth to that client if there are allowances available, and then at least your client can make that decision to say, yeah, I should look at this now. And 9 times out of 10, and it's more than that, they will say, yes, let's look at it now, because it's tax back. Everybody at the moment, any client you have, if you say, I'm phoning you about, or I'm sending you this email about some potential tax relief that you might be entitled to, will say, talk to me about it. It's a fantastic opportunity, but you're absolutely right, because it will come. You know, people say to me, should I wait till I sell the building then? No, do not. Why? You wouldn't have a bag of receipts for expenses and think, when I stop working and I retire, I'll put those expenses in, then I'll get the money back from the taxman. You do it as you go along. You know, the clients have the opportunity to do it now. So my advice would be, and it might be slightly biased advice because of our company, but I absolutely think it's the right thing to do. You've got a client bank there. Let's speak to the client. We'll give you the information that allows you to speak to them very straightforward, very simply. You know, because there is one question they might ask: why didn't you advise me about this at the time of the purchase? Okay. Now, if the accountant can look away at the moment, the opportunity that you have is to say that with commercial property lawyers, the tax position is down to the accountant. Of course, if you're all accountants, I'd be saying, you know what, there isn't an easy answer, okay? There is not an easy answer to that question, okay? But there's a far trickier question, which is when you get the phone call from the client that says, I've just had to sell this building, I've used another lawyer to sell the building, you didn't tell me about it at the time of sale last time, what we're going to do about it. That's a really, really hard question, you know. So I always think it's far better to let's raise it, let's make awareness, and you're proactive with your clients. You know, in terms of law firms, we don't need to talk about them, but in Manchester is a great example of law firms that are no longer with us, you know. And you've got to be proactive with clients, you know. It's not as simple as sitting there waiting for the phone to ring anymore, and I don't need to teach you that because you're here today, you know. The ones that aren't here today, that are sat there waiting for the phone to ring, are the ones that have got the challenge. You guys haven't. Hopefully that answered it with a slight bias, but thank you for that question.